Welcome to Tuttle Talk, a part of the Real Estate Radio Network. And now, live in studio, offering you a fresh perspective. He's your local real estate and finance expert. He's part of the Common Sense Party, and he's committed to teaching you how to win in any market. Your host, Andy Tuttle.
Good afternoon and welcome to Tuttle Talk on the Real Estate Radio Network, where we teach you what the rich and the banks do, not what they tell you to do, and where we dispel the misconceptions of financial wellness in the local real estate market and show you how following some basic principles really can free you up to focus on the other important areas of your life, like your friends, your family, and the community. It's the most important hour of radio every Sunday right here on 660 AM, The Answer in the great state of Texas. I'm your host, Andy Tuttle. Thank you so much for joining me. Today on the show, we're going to talk about a lot of things. I mean, my God, what happened on Wednesday? Bernanke does some speaking. The Fed does a little bit of this and that. Doesn't seem it's unusual. And the bond market falls out. The stock market retracts. What happened? We'll get to that. We're also going to get into the Dow. How strong is that bull really? Is it reaching its end, or is it still going for a while to come? And we're going to talk about the equity builder loan. This is a loan you got to hear about, guys. We're going to tell you what it is and how you can use it. And are there any other methods? Really, are there any other methods than just the traditional investing methods that you really can keep your money safe and secure and grow wealth? Or is that really just nonsense that's too good to be true? We'll talk to someone today that has some experience and a strong opinion on that. And then we get to my very special guest. He's been with us before. He's coming here again, Dr. Elliot Eisenberg, Ph.D. He is a chief economist out in D.C., president of Graphs and Laughs. You can actually check out his blog, econ70.com. It is a 70-word daily blog. You got to get it. He's humorous. He touches on the important economic topics of the day, and you're in and you're out of there, and you can really get a good grasp of what is happening. He's going to be with us on the show today to talk about the austerity measures, get his opinion on what happened in the markets this week and what we can expect going forward as far as housing is concerned. We've got a low inventory market here, as you know, 1.5 months of inventory. Is that going to get more anemic, or can we see some growth coming? Because I know a lot of you buyers out there, they're looking for homes, and you're like, my gosh, I can't even find one. I make an offer on it and I don't get it. Well, is there some hope for you? We'll tell you coming up in the second half of our show. Remember, you can reach us during or after the show. My off-air hotline, 214-736-9696, 214-736-9696, or email me questions at andytuttle.com. And you can become a fan of the show and get into the conversation on Facebook. Of course, you can find us at Tuttle Talk. And if you get out of your car, and I know you want to still listen to the show, you're going grocery shopping, put those headphones in, or maybe you're going for a jog or a bike ride around the lake, you can tune in and stream on your phone. Just download the 660 AM The Answer app, or you can even listen at iHeartRadio. So all those ways you can tune into this show and a lot of other great shows, especially on this station, that you can get your fix with, and we hope you do. And remember, when you call the hotline, someone on the other end of that phone that I have, they're going to ask you a couple of simple questions. One, they're going to ask you why you called. Of course, you're going to tell them that. And then they're going to ask you a couple of other basic questions, because I have charged them to make sure we're doing what's right by you to help you have a prosperous future. And so please answer those questions, and they'll help you out there, or you can just email me questions at andytuttle.com, and I'll get back to you as well. Okay, headlines, guys. What's hot? Well, Bernanke and the Fed meeting, that's what's hot. There's a lot of things going on, but, earlier this week, and I can't wait to get Elliot's opinion on this, but we had the Fed have their meeting, and they came out with some really basic statements that they always come out with. Hey, we're not going to taper right now. Yes, the economy's improving a little bit. We still plan on buying mortgage-backed securities. We're not going to be in the business of selling them. We see inflation as being under control. We see the economy as still in slow growth mode, but good growth. All some basic blocking and tackling. But the bond market dropped 100 basis points on Wednesday. The bond yield, you could say, rose that amount. We saw interest rates jump up 0.25% in one day. We saw the stock market fall back. And why did that happen? Well, I can tell you why I think the bond market fell down is because really they didn't care. Mortgage investors and the investors on Wall Street didn't really care that they are still going to buy mortgage-backed securities, which, by the way, we need to keep the interest rates low. That's that quantitative easing 3, QE3 you hear. All of that to sop up the mortgage supply, because the these mortgages get done, purchases and refinances. There's notes, the bonds, they're on the secondary market, right? You got to do something with them. What are you going to do with the supply? Well, you got to buy it up to keep the interest rates low. And so they've done that, and it's always been to put the training wheels on, if you will. And at some point, that's got to come off. But right now, the concern is it ready to come off? And so what they did and talked about just normally was say that, no, we're going to keep those on. But they said that the economy is improving, and that was enough to spook investors and I think overreact and say and I think Elliot will agree with me, but basically overreact and really do something that will end up correcting here in the next week or two. So I wouldn't worry too much about that, but just know that I've been saying this for weeks and months even. Interest rates are still on the trend up. So the more you wait to get the bottom, they're not going to the bottom anymore. They're tracking to 5 to 6% next year. So get in now, call now, talk to us now. You can call me, 214-736-9696, and talk to see if it makes sense for you to restructure your financing. We're happy to do that. Also, I want to talk to you about the equity builder loan. Guys, it's simply, we call it that because it's a renovation loan. I actually had a person call in named Tabitha. She had been working for months to try to find a way to renovate her home. She wanted to add some square footage. She wanted to update her kitchen and her bathroom. Basic stuff. Couldn't get it done. It was a beating. She finally got a hold of us, and we were able to help her. But it's, guys, if you have a home that is still got 70s wallpaper in it or 90s wallpaper in it, and it doesn't have the right finish out, you're, one, lowering the sellability of your home, and two, you're going to get below market because they can get the house next door that has been updated, right? That is up to the market. So in this situation, you can actually build equity in your home if you want to sell it to get the at market price and have better living quality of life while you're there. If you need to do handicap access, you can finance that in. You want to do some energy efficient upgrades, you can finance that in. You want to update that bathroom, get the granite countertops, do the pedestal sinks and all that fun stuff, get a walk-in closet because you got this little tiny one. Get out of the carpet, get the new carpet, get the hardwoods. You can do this stuff. It's easy to do, guys. We're here to help you do that. Don't feel like you got to pay cash for that. It could kill you right now. You need to be investing that money when the market's hot. So you can find out more about that. Questions at andytuttle.com. You know how to reach out to us. We'll be there to help you with that. And I want to remind you of that. And when we come back, we're actually going to get to, speaking of investing when it's a hot market, we're going to get with Steve McDaniel. Steve McDaniel is a guy, he had a securities license for over a decade. He used to tell everybody the same song and dance we all do about investing in the market, but he's got a different way now. He's got a unique perspective on this, and I want you to hear about it. It's kind of a tease for what's on later, and we'll also get with our good friend John Allen, and later we'll talk to Elliot Eisenberg about what's really going on in the market today and how your focus needs to be not only this year, but next year. All that next. Welcome back, Dallas. You're listening to Tuttle Talk on the Real Estate Radio Network. I am your host, Andy Tuttle. Thank you so much for staying with us here. Hope to give you some good, valuable information every single week about the local real estate market, about your financial well-being in order to help you have a more financially prosperous future, hey, and an enjoyable life as much as we can help you do that. So that's the idea here. Remember, you can reach out to me, 214-736-9696, 214-736-9696, and I'm going to have some people there to answer the phone. They're going to ask you why you called. Just let them know, and they're going to ask you a few more questions just to make sure we're doing our job. I've told them to do this in uncovering the opportunities that are there and making sure we're helping you build your financial team. Also, if you want to take advantage of some of the offers that are coming on here today, you can just text the number 72727. Text 72727. And you text the word talk now. It's all one word, no spaces. Text talk now to 72727, and you'll get you'll get a text message back, and you'll be able to take advantage of some of the offers that we have from our expert contributors and guests today. Speaking of guests, I have one with me right now, Steve McDaniel of Safe Money Millionaire. He's also got a great website at safemoneymaking.com, and he has a very unique perspective. He's been in, he's actually had a securities license and he was in the game watching the market. He bought into have everybody invest in the market for over a decade, but he's since changed his philosophy a few years ago, and he works with a very unique company and a unique strategy to help you build wealth without the risk of the markets. And in fact, a lot of the stock markets and the stockholders, brokers, they don't want you to know this stuff. So Steve is with you today to tell you what others don't want you to know. Steve, welcome to the show.
Hi, good to be here.
Good. So I know you like we talked about, you had your securities license for over a decade. You watched the market. You knew what was going on. You had people buy stocks, and it was a good way to do things. But what do you feel right now is the major challenge with the way people invest in the stock market?
Well, I think obviously the big thing is risk. Back whenever I had the securities license, this was back in the 90s when I acquired that. You couldn't lose money in the market, or so people seem to think. And so it worked out pretty good at that time. And of course, one of the challenges we had then was being able to outpace inflation. Things are a little different now. There's some really great things people can do to help themselves today without having to assume all that risk.
So in a market like we're in, where it is volatile now, hey, we're going to talk in a minute actually with Dr. Elliot Eisenberg about what's really going on in our economy and what we can expect. And we know that the economy is improving, but it's still a volatile market out there, as we saw earlier this week. A lot of things can happen in a day, and you want to keep your money safe and secure now more than ever, especially as you're getting older. So what can you do, if not the market, to keep your money safe and secure but still grow wealthy?
Well, I'm glad you mentioned that, because I like to illustrate the importance of this by using the old parable about the wise man building his house on the rock and the foolish man building his house on the sand. And when the storms blow in, the wise man's house stands strong and the foolish man's house falls. And that's so true when it comes to talking about your financial house. So important to have it built on the rock of safety rather than on the sands of risk. And I don't know if you've ever seen the foundation of a house fail, but you obviously know that if that falls, then the rest of the house is destroyed as well. And that's really our basic philosophy. The market's very unreliable, as you said. So it just really doesn't make sense in this day to build your house on it. And I feel this all the time because, unfortunately, that's kind of how our system's set up. Employers are doing away with pensions and encouraging people to put money away into their 401ks or whatever other qualified plan they have. And so really, to get back to your question about how to keep our money safe, the first thing you have to do is realize that you don't have to chase returns in order to grow wealthy anymore. And, Wall Street still likes to promote that. They tend to have people thinking you've got to really have a really high rate of return in order to get wealthy, and that's just not the case anymore.
And I'm happy to hear about that because, I do think there are other ways to get wealthy than just the standard traditional methods. And what I want to do for time's sake, Steve, is have you back. We're going to talk about that because I know you have a 7-step method, actually, and a proven program that helps people get out of debt. So, guys, and make wealth. So I'm going to, what we're going to do is bring you back on the show, and we're going to talk to you about that 7-step program. So if you're interested in this way, guys, this is kind of a tease to having Steve come back and next week, and he's going to talk to us about the 7-step program you can use to get out of debt and create wealth for you and your family. So, Steve, thank you so much for being here with us today.
Absolutely.
All right. We'll talk to you soon. You're listening to Tuttle Talk on the Real Estate Radio Network. Remember, you can reach us 214-736-9696. We'll get you in touch with Steve McDaniel, or we can get you in touch with any of the expert contributors here today. Okay, so now I really want to get to one of our expert contributors who I'm always happy to have here with us, John Allen, Texas Community Insurance. Thanks so much for being here.
Thanks, man. Glad to be here.
You got it. So, we've talked last time we talked about ACV value and some of these fun insurance topics that I know people love to hear about. But I know there are some changes in the insurance in insurance policy and how things work that really do affect the premium people pay, affect potentially the costs that people are going to pay. And I don't know a lot about that, but I know you do, and I want you to talk about that today.
Absolutely. So you're used to getting your renewals, and what is the first thing people look at renewals is what's my new premium, right? Well, in the current environment, and this has probably been going for the last 6 to 9 months, in the current environment, what's happening is not only are they taking price increases, a lot of carriers, but they're also cutting back on deductibles. So if in the past you had a 1% deductible, now maybe it's a 1.5% deductible, maybe it's a 2% deductible. Are they telling you that up front when you get the news, or are you just saying, oh, look, my premium is X and I'm going to put that away, right? So go ahead. So imagine the surprise. Imagine the surprise when you have a claim and you don't know that your deductible now is 2% instead of 1%. What does that mean? If you have a $300,000 house with a 1% deductible, that's $3,000 out of pocket. If that now moves to 2%, now it's $6,000 out of pocket. That's not a good surprise, right?
That's a huge bad surprise. But are you saying that these changes are happening after they already have their insurance in place?
After they already have their insurance in place. And that's one strategy that some carriers are doing. Another one is to say, well, we're going to reset the age of your roof ACV limit. Instead of 15 or 20 years like it was before, we're going to change it at 7 years. Or 10 years. And then another wrinkle on that theme is some of them are even saying, well, we're going to have replacement cost coverage, but we're going to have a sliding schedule of what percent of that roof we're going to pay for. So it's sort of like a modified ACV. So you really have to pay attention. It's not just about premium. It's also about, what's in it in terms of the deductibles and what's my exposure, what's my out of pocket.
So now when this is happening to the homeowner, right, to you, me, and now when is the time to review that? Am I getting something in the mail and statement saying some things have changed and then I don't know what those things are and everything looks kind of similar?
You should be, but the key is just knowing that that's the environment that we're in. Make sure you look at it. Make sure you touch base with your carrier, your agent. Make sure you're asking the questions, especially as it relates to roofs and ACV and deductibles, because that's where the carriers are able to recoup some of the costs.
Okay, so the main questions. One, what's my deductible currently?
Correct.
Right now. Second, what is, because you said something about going from 15 years to 10 years. What's the question they need to ask there?
How long is my roof going to be replacement cost, and at what point does it become ACV? That might be a little complex. Just maybe the easier way to say it is, what changes are you making to my coverage that I need to know about?
Okay, right? Perfect. That's a good open-ended question. Easy. Let them talk. Right. Look, and if they start getting wishy-washy on you or whatever,
call us.
That's exactly right. Call me, and I'm not kidding about this. This is why I use John, and our clients use John, and I have him on the show. I tell you this every week to remind you, because it's so important that you work with trusted professionals, and it's hard to find those. I've gotten burned. I think we all have. And this is why this team of experts is here every week, because they're not going to burn you. You're going to get taken care of. So if you're curious about that, if you just want someone to review it for you and help you ask the right question, John's that kind of guy. He's going to do it. But I'm going to tell you, you should ask him to quote you too, because I think he can save you money, but I know he's going to do the best combination of saving you money and making sure you're properly covered, because that's the last thing you want to deal with is when something happens to you and a tragedy happens, is to have a second tragedy of having the wrong coverage. So call us 214-736-9696, 214-736-9696. I'll get you connected with John. You can also email me questions at andytuttle.com. John, as always, thanks for so much for being here. Is there any final note on that?
No, just call me.
Make sure you're taken care of, guys. It's very important. So thank you so much, as always, John. Okay. You are listening to Tuttle Talk here on the Real Estate Radio Network. Coming up, we are going to get with our man, Mr. Elliot Eisenberg, Dr. Elliot Eisenberg, Ph.D. He has got a knack for making the minutia of economics fun, interesting, entertaining, and really breaking it down. So people like really me and most of you, I know some of you were scholars in this, but breaking it down for us to understand. We're going to talk a lot about what the austerity measures going on, what the crud did Bernanke say that spooked the markets, what to expect for the bond and the stock market going forward, the employment and job picture. He's a chief economist over in D.C., and he is going to enlighten us next. Welcome back, Dallas. You are listening to Tuttle Talk on the Real Estate Radio Network. I am your host, Andy Tuttle. Thanks for joining us again today. And we are here. We've been teasing this in the first couple of segments, but I'm so excited to have him here with us back again from last year. Dr. Elliot Eisenberg, Ph.D. He's the president of Graphs and Laugh. He has a unique ability to really break down all the minutia, really all the complicated economic data and just media blitz that you get. He breaks it down layman's terms so you can understand it and know what to do about it. Elliot, thank you so much for being here today.
Oh, my pleasure, Andy. It's always fun to be on your show. Thank you.
Well, you bet, man. It's my pleasure to have you. So I'm excited to get into the content today, and I want to get right to it. You and I both heard earlier this week, and a lot of people saw the Fed, of course, the Fed meeting, and then Bernanke's comments after they came out with the official Fed comments, and that whole media circus and show in the markets. Now, for us on the bond yields, they rose. We saw interest rates rise. We saw the stock market actually pull back some. We had a lot of things going on. What happened?
I'm not sure what happened, quite frankly. Bernanke didn't come out with anything really new. He just came out and said pretty much what he said last month in front of Congress. If things get better, and we expect they will, then we'll start tapering early. But then again, we may not. So I think he reiterated news, and I think the market really overreacted.
You know, I agree with it. And I think on this, too, and what do you think about this? On the bond market side of things, what we think is mortgage investors, all they heard, they didn't care about, hey, we're going to keep buying mortgage-backed securities. We're not going to put the brake on. We're only going to slow up the gas pedal. And that's probably not going to happen until next year. All the things that would make you feel comfortable, all they heard was the economy is improving. And they said to themselves, OK, that's it. QE3 is going to be done by the end of the year. And then they overreacted, just like you said.
And this is important to point out. Look, if interest rates are super low like they are now and they start to rise, it's generally a sign of improved economic conditions. And Bernanke was pretty careful to say this. He said, look, we're not going to raise the federal funds rate and the discount rate. It's going to stick at 1/4 of a point. We're not going to do that until 2015 probably. We're going to start tapering at the end of the year, maybe September, maybe November, maybe January. It'll take 6 or 8 months to taper off to get to zero. And then we're going to leave things in that new situation flat for 6 or 8 more months. And it's all data dependent. We're coming into a point now where the payroll numbers are really going to matter. Watch the payroll numbers every single first Friday of every month, because if those are elevated, they're in the 180,000, 190,000 numbers for the next 3 or 4 months, 3 months, that means he's going to start tapering earlier. But if we see 150, 160 probably at the lower end there, you're probably not going to see tapering. But because we don't know what's going to happen, these monthly numbers are going to matter. They're going to change markets. We're going to have increased volatility as a result. And it's really going to be data dependent right now. But the other thing is, look, one more thing here, important. If interest rates are low and they go up to, say, 4, 3, 4, 5%, this is a sign of a healthy economy doing nicely. If we have interest rates going up to, say, 7, 8, 9%, God forbid, that means you have a wildly overheated economy with lots of inflationary pressures coming in. We don't have that. If interest rates start to go up as they expect to do at the Fed and the economy slowly improves as I expect it to do as well, then interest rate rises are a sign of GDP health and growth, not nervousness and inflation. There's a difference.
And I want to get to that. I think that's a very good point. But you talked about payroll numbers. And first, I just kind of want to dig into that from my listeners. And just they understand 180,000, you mean new jobs. It's the payroll numbers, but it's the jobs report. How many new jobs are coming on the market versus what they expect? So 180 is a little higher. 150 is towards the low end. Would you dig into that more and why that's important as far as our economy and why it's a good sign to have 180,000 jobs?
Sure. If we consistently create 180,000 jobs a month versus 150, that's 30,000 a month times 12 months. That's 350,000 jobs. That's a lot of jobs. So small, numbers seemingly 10, 20, 30, 40,000 difference is a huge amount of difference. The problem is these numbers keep getting revised. They get revised up and down after a month or two because the estimation errors are huge. So you never can be totally sure what you're looking at on that first Friday of every new month. Right now we're creating 2 million jobs a year, which is about 170,000 jobs a month. 170 times 12 gets you 2 million. So at this point, we're just in this cycle where we're almost ready to start tapering, but we're not quite ready. If it goes up to 190, we're going to start to consistently, we're going to taper early. If it falls to 50, we'll taper late. But it's really that close. And that's why we're going to have market volatility, because every month we're going to wait for this number, and it's high. Oh, tapering's early. Oh, it's low. Oh, we'll have another month reprieve. And because we don't know, and because it's data dependent, we're going to get whipsawed a lot.
And I'm glad you went into that more. And I think, and tell me if I'm wrong on this, but from what I understand in my readings on this, 130, I believe, thousand new jobs is the bare minimum that needs to be created in the market every single month to keep us even somewhat stable. Is that correct?
Yeah, it's something roughly like that. It used to be a little higher. Now it's come down to a little lower because of demographic things and boomers retiring and not many Gen Yers entering the labor market quite so fast right now. But yeah, about 103 is what we need just to keep things constant. Nothing gets worse. The thing is, we've had reduced labor force participation rates. And that's why the unemployment rate keeps going down despite the not really dramatic increases in employment from month to month. It's 160, 170, 150,000 a month. We see plummeting unemployment rates. And it's not really a great measure, but the fact is people are leaving the labor force, so, that's what the unemployment number is. But yeah, we need 130 a month, yeah.
You're listening to Tuttle Talk here on the Real Estate Radio Network. My guest is Dr. Elliot Eisenberg. He is the president of Graphs and Laughs. He has a blog. You can check it out at econ70.com. It's a 70-word blog about what's going on in the economy. It's very quick hits every day. You can get a lot of great information from that. Elliot, real quickly on this. So when I think of this, and you talk about the jobs numbers and the unemployment numbers, and what the market's reaction to that, you're right. There are people that, one, they're leaving the labor force, and two, they've given up looking for a job because it's been so long, and so they fall off that number. So it gets artificially lower, and I think that's one of the concerns is if it continues to get artificially lower, then they see that as a sign to taper, that does cause a problem for our economy. What do you say to that?
Absolutely. And Bernanke mentioned that a couple days ago in his speech. He did say, hey, we pay attention to a whole lot of things. And if you look at some prior data on this, and it's very interesting, what seems to happen, and is that once the total employment level returns to where it was prior to the recession, now, in our case, it will take us another year to get there because this is an exceptionally long recovery, slow recovery. But when the total number of jobs exceeds the prior number of jobs before the recession, then labor force participation rates start to rise. So people start seeing, oh, my gosh, people are getting jobs hand over, left and right and hand over fist and all that kind of good stuff. And then they start jumping in. So it wouldn't shock me if in about a year's time or a year and a half from now, we start seeing increases in the labor force participation rate taking place. But nonetheless, if the labor unemployment rate starts to fall below 7%, as he said it might, and that will be a sign for tapering or whatever, that means we're going to have a little bit less slack in the labor market, and that will be a sign of another good sign of economic recovery. That's the point. The whole point of QE3 was to help the economy recover. At some point, we have to get off life support. And He's been telling us now for a month straight that it's coming sooner than later. That's the real takeaway message. I wouldn't be so concerned about September or January. Don't focus on that. I think focus on building a portfolio that can insulate you from this volatility and some rugged behavior in long-term bond prices.
I think that's a great point, and we actually have some other guests on today that follows up fantastically with, because it is important that this is a time to not put your head in the sand, and it's not a time to just let things, as you see the bull run in the down, you're like, woohoo, we're up above 15,000. Boy, I've been doing great. Don't let it go. This is a time to keep a pulse on what's happening in the marketplace. Talk to your financial advisors and those professionals that guide you, and make sure that you are being nimble and not just setting it and forgetting it. This is not that type of market. So last question here before we go to break is, you talk about employment and the employment numbers and the unemployment rate. Now, why has hiring not really picked up as much as we've expected it to?
There are a couple of different, if I knew the answer for sure, I'd be a billionaire, right? But there are a couple of different things. Large businesses have been very, very good at cutting their entire supply chains and increasing productivity, buying software, buying machines and more computers and stuff. So we're getting a lot more productivity out of people than we did. The productivity per capita is 8 or 9 or 10% higher than it was just 4 or 5 years ago. So we can do more with less. On the small business side, small businesses are still very, very nervous. Small business sentiment is not that great, and it's very different from the large businesses that are feeling pretty good, have lots of money, and have been able to restructure fix their capital structure and borrow money from the capital markets at low interest rates. On top of that, we've got Obamacare coming down the road. Obama made some noise about raising minimum wages. There's a tremendous amount of fear, uncertainty, sluggish growth, and decent productivity growth, which is all causing hiring to be substandard. Interestingly enough, however, at the same time, the other half of the labor market, the firings, this is involuntary terminations, have dropped back to normal levels. We're seeing those now return to where they were before the recession, so say back in 07, 06, 05, a normal labor market. And those are back to where they're supposed to be. So our weekly unemployment claims are back where they should be, but we're not creating enough jobs because of uncertainty. It'll come. Next year it should get there. And I think it'll get there in large measure because the fiscal headwinds that Bernanke and others have talked about are really quite severe now. Tax increases and government spending cuts on the fiscal side have clipped easily a point to a point and 3/4 off GDP. The fact that we're still growing at roughly 2% or 1.75 is quite impressive. Without these headwinds, we might be at 3%.
You're listening to Tuttle Talk here on the Real Estate Radio Network. We're talking to Dr. Elliot Eisenberg, Ph.D. And coming up, we're going to talk to him about the austerity debate that's going on right now. Do higher debt levels to GDP ratio, is that really what we should be focusing on right now? We are going to hear from Dr. Elliot about that subject next. Welcome back, Dallas. Thank you so much for joining us here on Tuttle Talk on the Real Estate Radio Network, the most important hour of radio every Sunday, 3 p.m., right here on 660 a.m. The Answer. Remember, you can reach me, 214-736-9696, 214-736-9696. You can also join the conversation on Facebook, facebook.com/Tuttle Talk. You'll get all the tips from the show, all the advice, and you'll get a lot more from our expert contributors. So join us there. Find us on Facebook at Tuttle Talk. We're talking with Dr. Elliot Eisenberg, Ph.D. He's got a great little blog on econ70.com. You can go there. He's the president of Graphs and Laughs. He's a chief economist. He's out of D.C., and he's just got a great way of breaking things down, breaking the complicated down, making it simple, and helping you understand how that matters in your life. So, Dr. Elliot, welcome back to the show.
Thank you. Glad to be on, as usual.
Yes. So, okay, before the break, we talked about austerity, the austerity debate that's going on right now. This is actually a little bit over my head. So, higher debt levels to GDP ratio and what happens there and what the real debate is and what we should really be focusing on. Would you do me a favor, give us the background on what's happening in the debate and then what the real issue that we should focus on is?
Sure. All right. So a couple of years ago, two economists named Rogoff and Reinhardt wrote a paper and wrote a book saying basically their research showed that when debt to GDP levels go above 90%, so when your total country debt approaches GDP, 90% of it, suddenly growth starts to slow down dramatically. It isn't that bad. Growth slows down earlier, but not much. And then after 90%, things really get bad. The Europeans took this piece of data and really changed changed a little bit, certainly their austerity beliefs. And I think they pushed austerity a little harder than they should have. And they did it with the understanding that if debt to GDP ratios get too high, we're going to pay for it down the road with lower GDP growth. And a lot of people were skeptical of this, and I was one of them that said, very rarely in life do you have something that's instantaneous. Like you go above 90 and things fall apart or whatever. I mean, rarely do you have like an acute sudden change and
tipping
things
point
happen wildly.
Right.
It's rare. It's rare. So I was skeptical, but hey, these guys are pros. What the hell? They know what they're talking about. Anyways, turns out they made some mistakes. They didn't include some countries in their analysis. It turns out, yes, as debt to GDP ratios go up, GDP growth slows down. True, but it doesn't happen. It happens sort of in a straight kind of line. The more the debt, the slower the growth. But there's no 90% threshold. There's no magical moment. There's no tipping point, if you will. So keep this in mind. Higher debt, slower growth, okay. All else equal, we'd like to have less debt. That's pretty obvious. But the deeper question that bothers me or concerns me most is what's the causality of this? Is it the debt that causes slow GDP growth? Or is it slow GDP growth that causes debt? Think about it. Japan was doing fantastically well until the late 80s, early 90s. Then their economy slowed, and their debt levels skyrocketed. So the question of what came first, the debt or the slow growth, really matters also. So I think the takeaway message from all this is debt matters, But GDP matters a lot, too. And I think I prefer to live here in the States where I live with decent GDP growth right now than in Europe, where they've done massive amounts of austerity and they've really punished themselves and kicked themselves into a second recession they're in a recession now, right now, a second recession for no really good reason. So this shows that in developed economies, all else equal, when you're already in weak growth or a recessionary situation, the last thing you want to do is tighten up on fiscal policy and tighten up on monetary policy and reduce debt levels when you're already in a recession. That really is not a good idea. So I think the Americans have got it right here, and what we're doing here is basically right, and letting austerity debate go for a while. We can deal with that once GDP growth gets above 2.5% or 3%, hopefully in a year and a half. Then we can go there.
Like that. Yeah, no kidding. And I love that you just kind of threw that in there. You know, they just left out a couple of countries. It's amazing what happens when you leave out some little bits of data like countries to put in your calculations.
I don't think they did it deliberately. They just made some spreadsheet errors. We all do that. We've all done stupid things in Excel.
That's
so
right.
did they. But the key thing is growth, less growth. We want more growth, certainly, but let's not. There's no false god here. Fix your economy, get it right, get it robust, and then deal with your problems.
Yeah, exactly. It's like they're shuffling around their spreadsheet papers, and it's like, anybody seen Grease? Nah, who cares? What's that?
That's just about right. Yeah, right.
We'll figure out the numbers with that. It'll be good. It'll totally work. All right, you're listening to Tuttle Talk. We're here with Elliot Eisenberg, Ph.D. Okay, so I really want to take this now focused in on, we've talked about the bigger picture. We've talked about, of course, a GDP, what happened with the Fed and our country's economic state currently, hiring, and some of the austerity measures here versus abroad. But I want to bring it down to another big factor in our economy, of course, housing, right? And we're at a point now where we feel like we've seen the bottom in housing, right? We're coming up out of that. We're seeing appreciation in a lot of markets. Case-Shiller's showing that. A lot of our obviously market here in Dallas has always been a little bit better than, as far as we didn't go into the recession as deep. We didn't stay to it as long. We came out of it earlier. But we're seeing now a different problem in that we have low inventory and we still have sellers that are a little hesitant to sell because, as we talked about earlier, the consumer confidence is growing, but it's not apparently where it needs to be yet to get these sellers to think that it's a comfortable place for them to sell and move up, move places, and get their kids out of the house again because they moved back in and all those kind of factors. So would you speak to where our housing market is now and where you see it going here in the next year or two?
The housing market is remarkably healthy. It really is. It's turned almost on a dime. It really bottomed out end of 11, and the whole year of 2012 was getting the table ready and getting it going. And it's a very, very low level. So even in 2012, we may have had a 20% growth in housing starts, but it went from 400 to 500,000. I mean, they're small total numbers. They weren't very meaningful. But now we're really beginning to see housing starts really improve, and I think that they can and they probably will grow by 200,000, 250,000 units a year for the foreseeable future. Say 200,000 between single and multifamily growth over the next 2 or 3, 4 years. So we'll go from 1 million this year to 1.2 million to 1.4 million to 1.6 million. It will be a pretty good growth because our labor markets are not great, but they're pretty good. And each of these people that gets a job, every 1.3 of them or so needs a place to live. On top of that, there is, houses that fall down because of storms and obsolescence and hits a wrecking ball. We have a couple 100,000 of those. We have population growth going as well. And collectively, we'll need about 1.6, 1.7, 1.8 million homes being built for the foreseeable future. We're underhoused right now. Even though our employment is not as good as we'd like it to be, we're still underhoused. So house prices will go up a little bit. I'm hopeful that supply of houses will go up. There'll be more inventory, and that will put a cap on price growth. We don't want to see prices rise wildly here, but this is good. This is going to be a major driver of the economy going forward. Easily 0.5 percentage point contribution for the next 3 or 4 years.
So, on that note, we have a lot of sellers here and a lot of realtors in the marketplace that listen to this show. We have 1.5 months of inventory here. It's anemic. And it's something that is actually concerning a lot of the people and the buyers who are looking for homes and they can't find one right now. What Is that going to stay that way, or is this increase, do you think, going to slowly open up the inventory and really make it 2.25, 2.5 months?
Yeah, I think it will start to rise. The data that I'm looking at, certainly nationally, I'm not an expert in Dallas here, right, says that inventory has probably hit its lowest point right now, and it will grow because house prices are rising. More people are willing to sell their house. The fewer people are underwater, more will make money when they sell their home. So they're going to start so we're going to have a little bit growth in inventory from that side, and we'll build more new homes. And that will also help the situation. It's not going to get better overnight, unfortunately. It changed quite dramatically from 12 or 13 or 16 months of inventory down to 1.5 in about a year and a half. It went from unbelievable amount to none. It won't get better. It won't reverse its course nearly that quickly, but it will slowly get better. It will get better. Inventories will rise.
That's good to hear. Remember, they only rise if you help. One of the reasons they rise anyway is that you get your house on the market. Appreciation is happening. To help that continue to happen by getting off the fence, this is a great time to harvest some of the equity from your home now that the appreciation has happened and invest in a new home because interest rates are going up. They're going to head up to 5.5, maybe more %. So you got a great opportunity there. You've seen appreciation in your home now. You don't want to, if you buy a home later, though, next year, you may see more of that and you're going to be able to buy a little less house. So this is a good time to get the best of both worlds. And you heard it from here, our good friend, Dr. Eisenberg. Thank you so much for being back on the show. Remember now, you still speak at events, right? Weddings, bar mitzvahs, all that good stuff.
Very funny, but yes, absolutely I do. I'm a public speaker. I visit 60, 70 cities a year and have a terrific time. If you're interested, get a hold of me.
Good. Do it. And you can check him out again, econ70.com. That's an easy no-brainer. Sign up for Graphs and Laughs, 70 words a day to really give you a really great idea of what's happening in the market. So, Dr. Eisenberg, we're going to have you back. Thank you so much. Get in contact with us. If nothing else, 214-736-9696, and we'll get you in contact with Dr. Eisenberg. Thanks again, man. Have a great weekend.
Thanks, Andy. Thank you.
You bet. Okay, guys. That is it for today. I hope you have enjoyed this hour here on Tuttle Talk. Remember, you can email me questions at andytuttle.com. You got to check out econ70.com. I look at that every day. I love to see his take on the market, and the fact that he can wrap up so much data in 70 words cracks me up, and it's very good information and it's quick read. So do that. Also, get your boots on, bootcampaign.com. This is a great time to order it, too, because we are going to be wearing ours in 2 weeks. You can wear them every Friday, and you can post them, but we wear ours the first Friday of the month and post pictures and do all that. So please do that with us and join us in supporting our troops. And don't forget, you can also go to yourmortgagereview.com, yourmortgagereview.com. Take 5 minutes. You can complete a short survey and find out if it makes sense for you to look at restructuring the financing on your home right now, doing a renovation loan, doing anything that may involve helping you get better financing in the marketplace right now. And you get a free copy of your credit report and a great consultation to show you your total savings analysis. So we're here to help you with that. I'd like to thank my expert contributors today. I'd like to thank Elliot Eisenberg and Steve McDaniels. And, of course, I'd like to thank our production director, Dan Bradford. That's it for today. This is Andy Tuttle for the Real Estate Radio Network. Remember to find me on Facebook. Just go to Tuttle Talk and you'll see us there. And tune in next week where we're going to talk to a financial advisor that's doing some fantastic things in the marketplace and a broker from California who's also a host on the radio show out there. Let's find out what California's doing right now compared to us. So thank you so much for tuning in where we're making financial intelligence a priority in the community. Have a great weekend.
You've been listening to Tuttle Talk on 660 AM The Answer. You can reach Andy at 214-736-9696. That's 214-736-9696. Or email him, questions@andytuttle.com. Don't forget to become a fan of his show by going to facebook.com/Tuttle Talk. You can also catch previous shows by going to andytuttle.com.